Hey everyone, welcome back to Corporate Decoder, the place where we peek behind the curtain to see if the corporate magic is real or just a lot of smoke and mirrors. Today we are digging into AGENUS Incorporated's report that dropped in mid-January 2026. Now, AGENUS is a company that has been working in the cancer immunotherapy space, and this report is all about some pretty significant deals they've made. Think asset sales and some strategic partnerships. Will break down what this actually means for the company and for their future. Before we dive in, if you love getting straight to the point financial analysis, make sure you're subscribed. And hey, we've got a fantastic community over on Discord, link in the description below, come hang out. So the 15th of January 2026 was a big day for AGENUS. This report is primarily about two major events that happened on that date. First up, they completed the sale of a big chunk of their business. Remember, way back in June of 2025, AGENUS and its subsidiary AGENUS West entered into an agreement to sell most of their manufacturing operations to a company called Zetas Pharmaceuticals USA Incorporated, or Zetas as we'll call them. This sale included things like their real estate, their equipment, and some ongoing contracts. On the 15th of January, this deal officially closed and AGENUS pocketed a cool $75 million. Now that is before some expenses and other payments they had to make, but it is still a significant amount of money. This was a pretty big deal for AGENUS. Essentially meaning they've significantly slimmed down their operations by selling off these manufacturing assets. But it is not just a straight sale. At the same time this asset sale closed, a related licensing agreement also became active. This agreement with Zydus Life Sciences Limited, which is the parent company of Zydus Pharmaceuticals, gives Zydus the exclusive rights to develop, manufacture, and sell AGENUS' special cancer immunotherapy drug products. This license is specifically for Sri Lanka and India. So while AGENUS sold off its manufacturing muscle, they're also getting a royalty or some form of benefit from their intellectual property being used in other parts of the world. It is a way for them to still profit from their innovations, even after selling the physical production side. Now, the second big thing that happened on the 15th of January, also linked to that initial sales agreement from June 2025, is an equity deal. AGENUS entered into a securities purchase agreement with Zynext Ventures USA LLC, another subsidiary of Zetas Life Sciences. Under this deal, Zynext agreed to buy about 2.1 million shares of AGENUS' common stock. The price wasn't cheap either. They paid $7.5 per share for a total of around $16 million. So not only did AGENUS sell off assets, but they also brought in a significant investment from a related party. This often happens in these types of deals to strengthen the balance sheet. To get the word out about these two major events, AGENUS put out a press release on the 15th of January. This report is filing that press release as part of the official record. Basically, it's them telling the public, hey, we just closed these big deals. Now, it's important to note that the information in this specific section is generally not considered officially filed for certain legal purposes, meaning it is more of a disclosure to keep everyone informed. And of course, with a deal this size, there are financial statements to back it all up. The company included unaudited pro forma, which means for the sake of form, or as if it happened financial information. This includes balance sheets and statements of operations as if these deals had already happened at an earlier point in time. This helps investors see what the company would have looked like financially if these transactions had been in effect earlier. Looking at the pro forma balance sheet as of the 30th of September 2025, we can see how these transactions would have impacted their financial position. It is showing a snapshot of what AGENUS would have looked like with the cash from the sale and the investment, but also without the manufacturing assets. The pro forma statements of operations for the year 2024 and the first 9 months of 2025 show how the company's revenues and expenses would have been affected. We'd be looking for reduced costs related to running those manufacturing operations, but also potentially reduced revenue from that segment. The key here is whether the remaining business and the cash inflow offset any potential downsides. We have the press release as Exhibit 99.1, which is the official announcement, and Exhibit 99.2 gives us those pro forma financial statements, which are the crucial numbers to analyze the impact of these deals. Signed off by Garo H. Arman, the chairman and CEO, on the 16th of January 2026. So what is the real story here? AGENUS clearly decided to streamline its operations. By selling off its manufacturing assets, they're shedding a lot of the costs and complexities that come with running factories. This brought in immediate cash. A significant $75 million from the asset sale plus that $16 million investment. This should really help shore up their financial position, especially important for a company in a capital-intensive field like biotech. The licensing deal with Zetas is a smart move too, allowing them to monetize their intellectual property globally without the burden of manufacturing. The risk for AGENUS now lies in whether their remaining business, focusing on drug development and innovation, can generate enough revenue and success to justify this strategic shift. They've essentially become more of a pure-play research and development company. The 7.50 per S-share they got from Zynext is also noteworthy. It is the price they were willing to sell shares at, giving us a benchmark for their stock valuation around this time. In my opinion, this move signals a more focused strategy for AGENUS. They recognized that managing large-scale manufacturing wasn't their core strength or perhaps the most efficient use of their resources. By partnering with Zydus, they leverage that company's manufacturing capabilities and market reach, while AGENUS can concentrate on what it does best, discovering and developing new immunotherapies. The key question moving forward will be the success of their pipeline and the terms of that licensing agreement in the long run. It is a bold step towards a leaner, potentially more agile company. Alright, that is our breakdown of AGENUS's big moves in early 2026. What is your take on this shift towards a more focused R&D strategy? Do you think selling off manufacturing was the right call? Let me know your thoughts in the comments below. If you found this deep dive valuable, please hit that like button, it really helps us out, and subscribe so you don't miss any future corporate breakdowns. And hey, don't forget to join our growing community over on Discord. The link is in the description. Thanks for watching, and we'll see you in the next one.